Welcome to the Deep Dive. Today we're jumping straight into Workday's Q1 results for fiscal year 2026. These just came out May 22nd.
Right. And Workday, well, anyone in enterprise software knows them. It's a big AI platform, handles people, money, even these things they call agents. And they're used by, over 11,000 organizations. Huge global footprint, more than 60% of the Fortune 500, I believe.
Exactly. So for our deep dive today, we're using their official earnings release and the investor presentation they put out alongside it.
Standard sources for this kind of analysis.
Yep. And our mission, really, for you listening, is to get past the surface level. We want to unpack the key numbers, the strategic moves they're making, and what their outlook tells us about where they're heading.
Sounds good. A clear picture of their current health and direction.
So let's kick off with the overall financials. What jumped out at you first from the headline numbers?
Well, the revenue growth is definitely solid. Total Q1 revenue hit $2.240 billion, which is up 12.6% compared to last year. And importantly, the subscription revenue, that's the core for a SaaS business like this, that grew even faster, up 13.4% to $2.059 billion. Consistent double-digit growth there is, a really positive sign.
It is. But then looking at operating income, the picture's a bit mixed, isn't it? GAAP operating income was, $39 million?
Nearly 1.8% of revenue, and that's actually down from $64 million, or 3.2% last year.
So what's driving that decrease?
It seems pretty clear from the release. They had significant restructuring expenses this quarter, about $166 million.
Okay. One-time costs, essentially.
Exactly. Those hit the GAAP bottom line in the short term.
Got it. Because the non-GAAP operating income tells, a very different story. That came in at $677 million.
Right, a really strong 30.2% of revenue. And that's a big jump from $515 million or 25.9% margin last year.
So maybe just quickly, for listeners, non-GAAP typically excludes certain items.
Yeah, companies use it to show the underlying operational performance. Workday, like many tech companies, excludes things like share-based compensation, those restructuring costs we just talked about, and amortization related to acquisitions. It gives a different perspective on profitability trends.
Understood. And how did all this flow down to the earnings per share?
Well, as you'd expect, the GAAP diluted EPS was $0.25. Down from our $0.40 last year, mainly because of those restructuring charges.
Okay.
But the non-GAAP diluted ETS, that showed really healthy growth. It climbed to $2.23 from $1.74.
So the underlying earnings power, stripping out those temporary costs, looks pretty solid.
It does, yeah.
Now, looking forward, the subscription backlog is always a critical metric for SaaS companies. What are those numbers telling us?
This is where you get a sense of the future revenue pipeline. Their 12-month backlog, so revenue expected in the next year, hit $7.63 billion.
Wow.
That's up a healthy 15.6% year over year. And the total backlog, looking further out, is even bigger at $24.62 billion, up 19.1%.
So that suggests pretty strong demand continuing. Good visibility.
Definitely. A growing backlog like that indicates ongoing sales momentum and gives them, a good degree of confidence in future subscription revenue.
That makes sense. And what about cash flow? Always a good indicator of business health.
Absolutely. And the cash flow numbers looked good, too. Operating cash flow was up to $457 million from $372 million.
Oh, okay.
And free cash flow, which is operating cash flow minus capital expenditures, saw an even bigger jump, $421 million compared to $291 million last year.
That's a significant increase. What does that signal?
It signals a really healthy core business. They're converting profits into actual cash very effectively, which gives them a lot of firepower for, reinvestment, acquisitions, or returning capital to shareholders.
Speaking of returning capital, I saw they were active with share repurchases. Bought back about 1.3 million shares.
Yeah, for around $293 million. And they also approved a new $1 billion share repurchase program.
Why do companies typically do that? Buy back their own stock?
Yeah. Well, there are a few reasons. It's one way to return cash to shareholders. It can also boost earnings per share by reducing the share count.
Right.
And, sometimes it signals that management feels the stock is undervalued. It's like a vote of confidence in the future.
And they certainly seemed to have the cash to do it. Their cash position looked very strong.
Extremely strong. They ended the quarter with $7.97 billion in cash equivalents, and marketable securities.
That's a huge cushion.
It really is. It gives them enormous flexibility. They can fund R&D, make strategic acquisitions, easily handle these share buybacks, or just weather any economic uncertainty.
Okay, so financially, despite the GAAP impact from restructuring, the underlying picture looks pretty robust.
Yeah.
Let's shift gears then to the strategic side. What were the key growth drivers and highlights they talked about?
Well, the CEO, Carl Eschenbach, his comments really honed in on how Workday fits into the current business environment.
That's so.
He emphasized that CEOs everywhere are focused on efficiency, agility, growth, the usual suspects.
Yeah.
And he positioned Workday's platform, especially with AI, now deeply integrated as like the core tool to help customers actually achieve those things.
Makes sense.
Hmm.
And the CFO, Zane Rowe, did his comments echo that?
Pretty much, yeah. Rowe talked about making good progress on their strategic growth areas and also continuing to find efficiencies in their own operations.
Right.
And importantly, they reiterated their full-year subscription revenue guidance, which shows confidence, and they actually raised their non-GAAP operating margin guidance for the year.
Okay, so confidence in both the top line and profitability improving.
Exactly.
Now, you mentioned AI integration. That seems like a massive theme. They introduced something called Illuminate Agents.
Yes. And this is interesting because it moves beyond just talking about AI capabilities to like specific tools.
Right. Practical applications.
Exactly. These Illuminate agents are AI tools designed to speed up specific tasks. Things like hiring, improving experiences for frontline workers, simplifying finance processes, even just helping employees find information faster.
Oh.
It feels like a shift towards making AI tangible within their platform.
And they gave that Evisort example, which sounded quite powerful. Real-world impact there.
Oh, definitely. That was about integrating Evisort's AI for contract analysis into Workday. And they highlighted results from an early user, Western Union. They apparently saw a 65% faster contract processing time.
Yeah.
And get this, roughly a 70% reduction in what they were spending on outside legal help for contracts.
70%. That's huge.
It really is. That kind of measurable ROI is exactly what businesses are looking for from AI right now. It makes the value proposition very concrete.
No kidding. Huge efficiency gains. Okay, so beyond AI, what about customer wins? Are they still bringing in new names and growing existing accounts?
Yeah, they highlighted both. New customers mentioned included some big names like Dover Corporation, Mutual of Omaha, United Airlines.
Right.
And they also saw major expansions, so existing customers buying more or deploying wider with companies like ASDA, Chipotle, CVS Health, and Decathlon.
So a good mix across different industries.
A very good mix. Which leads to another point they made, their industry diversification.
Ah, yes. They hit a milestone there, didn't they?
They did. 2 more industry verticals, technology and media, and manufacturing each crossed the $1 billion mark in annual recurring revenue, or ARR.
So how many does that make now?
That brings them to 5 verticals over $1 billion in ARR. The others being financial services, retail and hospitality, and professional and business services.
So their revenue base is getting broader, less reliant on any single sector.
Exactly, which generally means more resilience.
And they also picked up some external recognition during the quarter. Industry validation.
They did. Gartner named them a leader in 2 Magic Quadrants, one for higher education student information systems and another for talent acquisition suites.
That's significant validation.
It is. And separately, they were also named one of the world's most ethical companies by Ethisphere for the 5th year running. That speaks more to their corporate character, but it adds to their overall credibility.
Definitely. It sounds like they're also making specific plays, targeting certain roles or market segments, like the CIO maybe.
Absolutely. They mentioned growing demand for something called Extend Pro. That's their tool that lets customers build their own AI apps on the Workday platform.
Ah, interesting. So empowering customers to innovate.
Right. That's clearly aimed at the CIO agenda. And then for the smaller end of the market, emerging and medium businesses, they launched Workday Go.
Workday Go. What's the pitch there?
Speed and simplicity, basically. It offers faster implementations, like 30 to 60 days, using pre-configured setups and fixed pricing. It's a way to make Workday more accessible for smaller organizations.
Smart move.
Yeah.
And any progress in specific sectors like, say, government or education?
Yes. They noted higher attendance at their federal forum, suggesting growing interest in the U.S. public sector, particularly around AI and security needs for the workforce. And in higher ed, besides the Gartner recognition, they signed up new colleges like Center College and Gannon University and had successful go-lives of their student system, like at the University of Arkansas system.
So continued traction there. And globally, are they still expanding internationally?
Definitely. A couple of key things there. They went live on the AWS public cloud in the UK.
Important for data residency and performance in the UK.
Exactly. And they announced a new EMEA headquarters in Dublin, signaling commitment to Europe. Plus, they listed off customer wins across EMEA, Opella Healthcare, George Fisher, others, and also in Asia Pacific and Japan, like Swinburne University, Mitsubishi Motors. So, yeah, global expansion is still very much part of the strategy.
Okay, so a lot happening on the strategic front, really pushing AI, expanding markets, targeting segments. Let's pivot back to the financials, but looking forward now. What guidance did they give for Q2 and the full year?
Okay, so for Q2 of fiscal 26, they're guiding for subscription revenue of $2.16 billion.
And the growth rate?
That implies about 13.5% year-over-year growth. And for non-GAAP operating margin in Q2, they're guiding to 28.0%.
Okay. And for the full fiscal year 26?
They held their subscription revenue guidance steady at $8.8 billion. That's about 14.0% growth for the full year.
Right.
But as we mentioned earlier, they actually raised their non-GAAP operating margin guidance for the full year slightly, now expecting approximately 28.5%.
So expecting slightly better profitability for the year than they previously thought.
Correct.
What about professional services revenue? Sometimes that can fluctuate.
They gave guidance there too, expecting about $700 million for the full year, with around $180 million of that coming in Q2.
Got it. And the backlog growth expectation, that CRPO metric.
For Q2, they expect the 12-month subscription backlog, the CRPO, to grow between 15% and 16%.
Okay.
They did mention that includes about 1 percentage point benefit from some tenant contracts, and they expect a similar impact from those contracts each quarter for the rest of the year.
Right. And it's always worth remembering the difference between the GAAP and non-GAAP margin outlooks.
Absolutely. They specifically called out that they expect the GAAP operating margin to be about 20 percentage points lower than non-GAAP in Q2 and around 21 points lower for the full year.
Primarily due to those exclusions like stock compensation and potential future restructuring or acquisition costs. And quickly, any guidance on tax rate or cash flow?
Yeah, they expect a non-GAAP tax rate of 19% for the full year, and they maintained their operating cash flow outlook for the year at $2.75 billion. Capital expenditures are expected to be around $250 million.
Okay, so if we were to try and pull all of this together, the results, the strategy, the outlook,
Yeah.
what are the main themes or key takeaways for you?
Well, a few things stand out. First, I'd say the durability of their business model. Steady subscription growth, even in a somewhat uncertain economy.
Right, resilience.
Resilience, exactly. Second, the relevance of their platform. It seems to be hitting the mark for companies focused on efficiency and agility right now. Third, the AI story is becoming much more concrete. It's not just talk. They're showing specific tools and, crucially, demonstrating real ROI, like that Evisort example.
That felt significant.
It did. Fourth, just the continued expansion across different industries, different geographies, different company sizes. They're broadening their reach.
Diversification.
Yep. Fifth, you see the strategic investments continuing in AI, partnerships, global markets. And finally, there's clearly a strong focus on balancing that growth with profitability, hence the margin improvement and the raised guidance there.
That's a great summary. So basically, Workday's Q1 showed solid growth, particularly in subscriptions, strong underlying profit, real momentum with AI delivering actual value, key customer wins, keeping the pipeline full, and a generally optimistic outlook for the year ahead.
I think that covers it. The key message for you listening is that Workday looks resilient, yes, but also actively innovating, especially using AI to solve real business problems. That keeps them positioned as, a major player in how companies manage work.
Right. And that actually leads nicely into a final thought for you to chew on. Given this big push by Workday and others on AI-driven efficiency and, how the lines between human workers and digital or AI workers are blurring, how might these kinds of integrated platforms fundamentally reshape not just processes, but maybe even organizational structures themselves? How we think about talent strategy in the next few years. It's definitely something worth watching.
It really is a fascinating question for the future. And of course, if you want to dig into all the details yourself, the full earnings release and presentation are up on Workday's investor relations site.
Excellent. Well, thanks for joining us for this deep dive.